NYSEG's youngest mayor falters as Boston Properties' $2.4 billion Midtown office tower sits half empty. Boston Properties doesn't build speculative towers. That's not how the largest publicly traded office developer in the country operates, and it never has been. Every major project in the company's portfolio, going back decades, gets built against a foundation of pre-leasing commitments, anchor tenants signed years before a single steel beam goes up, financing structured around confirmed occupancy rather than optimistic projections. It's a conservative approach in an industry known for exactly the opposite. And it's the reason Boston Properties has survived multiple real estate downturns that wiped out flashier competitors, including the early 1990s real estate collapse and the 2008 financial crisis, both of which the company weathered while several of its more aggressive contemporaries didn't survive in any recognizable form. That discipline is baked into the company culture at every level, from how site selection decisions get made to how the leasing team is trained to walk away from a project rather than proceed without sufficient pre-commitment, even when a hot market makes proceeding on spec tempting. Analysts covering the commercial real estate sector have described Boston Properties for years as the industry's most risk-averse major player, a reputation the company has actively cultivated because it translates directly into lower borrowing costs and steadier institutional investor confidence over multiple market cycles. That discipline was supposed to protect the company's newest Midtown tower, a 62-story, 2.4 million square foot office building on 6th Avenue that broke ground 4 years ago, with roughly 55% of its space already committed to a handful of anchor tenants, including a major law firm and a global consulting company, both signing 15-year leases at rates that made the $2.4 billion project pencil out comfortably on paper. That level of pre-commitment, well above the company's own typical threshold for green-lighting a project this size, was exactly why Boston Properties Board approved moving forward on what would become one of the largest single-office developments to break ground in Midtown in over a decade. The tower topped out on schedule last fall. It opened for occupancy in January, on budget, exactly the outcome Boston Properties' methodical approach is designed to produce, complete with a ribbon-cutting ceremony that drew city officials eager to be photographed in front of one of the largest private investments in Midtown office space in recent memory. 6 months later, it's sitting at just under 48% leased, well below the 70% threshold the project's own investor materials identified as the minimum needed to hit projected returns within the first 3 years of operation, and considerably below where a building with this much pre-commitment should realistically be 6 months after opening, based on Boston Properties' own historical lease-up patterns on comparable towers. The anchor tenants moved in as planned, occupying their committed floors exactly on schedule, generating the steady, predictable cash flow the original financing was built around. The problem is everyone else. Prospective tenants who had been in active negotiations for the remaining floor space throughout construction started pulling back roughly 4 months ago, at almost exactly the moment a new commercial tax assessment took effect across Midtown's highest value office corridor, a timing correlation too precise for Boston Properties' leasing team to write off as coincidence. City Hall has pointed to the building's anchor tenants and its on-schedule completion as evidence the project itself is a success story, careful to avoid engaging directly with the vacancy numbers whenever reporters have raised them at press briefings over the past month, a framing that technically isn't inaccurate but leaves out the specific, quantifiable gap between where the building sits today and where its own investor materials projected it would be by now. There's a number buried inside the tax assessment's own underlying methodology that never made it into a single public statement from the city, and it explains with real precision why prospective tenants started walking away from one of Midtown's most anticipated new towers almost the moment it opened its doors. You don't have to work in commercial real estate for this to matter to you. Any city trying to raise revenue from its highest value commercial districts eventually runs into this exact tension, where the properties best positioned to absorb new costs on paper are often the ones most exposed to losing tenants who have somewhere else to go. Subscribe before we continue, because the number ahead didn't come from a press release. It came from a comparison two commercial real estate brokers ran independently after noticing the same pattern in their own client conversations. And once you see the comparison, the vacancy numbers stop looking mysterious at all. February 2026. As part of a broader effort to generate revenue from the city's highest value commercial real estate without raising rates uniformly across every neighborhood, Mayor Mamdani's administration implements a new tiered commercial property tax assessment specifically targeting office buildings in Midtown's core corridor, the roughly 20-block stretch running along 6th and 7th Avenues that has historically commanded the city's highest office rents. The logic behind the policy is straightforward and, on its face, reasonably progressive. rather than raising commercial property taxes evenly across every borough and every commercial corridor, including struggling ones still recovering from years of elevated vacancy. The administration targeted the increase specifically at the highest value properties in the highest demand corridor, reasoning that buildings commanding premium Midtown rents were the properties best positioned to absorb additional tax burden without meaningfully affecting their competitiveness. The tax increase itself, a roughly 14% jump in assessed value specifically for buildings in this defined corridor, was modeled by the city's revenue office using historical occupancy and rent data from the corridor as a whole, averaged across dozens of buildings built at different points over multiple decades, financed under wildly different terms, most of them long past the initial lease-up period where vacancy risk is highest. Here's what that averaged historical data obscured almost completely. A 50-year-old office tower in this corridor, largely depreciated, financed decades ago under terms that have long since been paid down or refinanced at favorable rates, can absorb a 14% tax increase by passing a relatively modest amount through to existing tenants at lease renewal, spread across a stable, already leased tenant base with limited ability to relocate mid-lease without breaking a contract and incurring real financial penalties for doing so. Boston Properties' new tower is a fundamentally different asset. It's brand new, still in its critical lease-up window, competing directly against comparable new construction in Hudson Yards and other corridors that fall outside the new tax boundary entirely, where a nearly identical floor of Class A office space doesn't carry the same tax premium and where a prospective tenant faces no switching costs at all, since they haven't signed anything yet. That distinction matters enormously and appears nowhere in the fiscal analysis City Hall released publicly. An existing tenant renewing a lease faces real costs to relocating: the expense of a full office build-out elsewhere, the disruption to operations during a move, the simple inertia of staying put. A prospective tenant who hasn't signed anything yet faces none of those costs. For that tenant, the decision is a pure, uncomplicated price comparison between two otherwise similar options, and the tax corridor boundary becomes the single deciding variable in a way it never would for an already settled, already leased tenant simply absorbing a modest renewal increase. For a prospective tenant comparing a still half-empty Boston Properties floor against a comparable floor in a competing building 4 blocks away that sits outside the newly taxed corridor, the tax increase doesn't get absorbed quietly into a renewal negotiation with an existing tenant. It shows up immediately, transparently, in the asking rent on a brand new lease being actively compared against buildings that don't carry the same cost. Commercial brokers, the ones who ran the independent comparison, found that effective asking rents in Boston Properties' new tower now sit roughly 9% higher than functionally comparable space in buildings just outside the tax corridor boundary, a gap that didn't exist before the assessment took effect, and that exists specifically because of where the city drew its geographic line. The city's revenue office projected the new assessment would generate approximately $290 million in additional annual tax revenue, calculated against the corridor's existing occupied square footage at the time the policy was designed. What that projection didn't model, at least not with any public rigor, was how a brand new building still actively competing for its remaining unleased space would respond to a tax increase that its established, already leased neighbors could simply pass through quietly at renewal, while Boston Properties has to embed the cost directly into every new lease negotiation it's actively trying to close. Step into the position of Boston Properties' leasing team, because the story stops being an abstract tax policy debate the moment you do. They've been in active negotiations with 3 separate prospective tenants over the past 4 months, each conversation following an almost identical pattern once the topic of effective rent came up. A financial services firm looking to consolidate 2 smaller offices into 1 large floor ran the comparison itself, found a comparable floor plate 4 blocks north in a building outside the tax corridor at a meaningfully lower effective rate, and signed there instead, a decision the firm's own real estate advisor described as straightforward once the tax differential was on the table, requiring no agonizing internal debate at all once the numbers were laid side by side. A mid-sized law firm that had been genuinely enthusiastic about the building's amenities and location during 2 separate site visits ultimately passed for the same reason, telling Boston Properties' leasing director directly that the firm's partners simply couldn't justify explaining a 9% rent premium to their own partnership when a comparable space existed a short walk away without it. That's not a hypothetical. That's a documented conversation, one of several, where a specific, quantifiable number was the deciding factor in a tenant choosing a competing building, not any dissatisfaction with the building itself, its amenities, or its location. A third prospective tenant, A mid-size advertising agency that had gone as far as commissioning preliminary space planning drawings for a floor in the tower quietly went dark on the negotiation about 6 weeks ago, and Boston Properties leasing director only learned through an industry contact that the agency had signed elsewhere, in a building just outside the tax corridor, without ever formally communicating the decision back. That kind of silent withdrawal, according to brokers who track these patterns, has become increasingly common across the corridor since the assessment took effect. Prospective tenants simply routing their search elsewhere, rather than engaging in a negotiation they've already decided isn't competitive on price. The building's ground floor retail tenants feel the vacancy indirectly, but just as concretely. A café that signed its lease specifically anticipating the foot traffic from a fully occupied 2.4 million square foot office tower is currently serving roughly half the daily customer volume its original business plan projected, because half the office floors above it sit empty during the exact lunch rush the café's staffing and inventory decisions were built around. The cafe owner didn't get a vote on the tax corridor boundary. She got a lease she signed based on projected foot traffic that a policy decision made 6 months into her tenancy quietly cut in half, and she's now reconsidering whether to renew her own lease when the initial term comes up in 2 years if the building's occupancy hasn't meaningfully improved by then. The building's own maintenance and security staff, hired at full complement based on the building's projected occupancy timeline, are now operating a nearly 2.4 million square foot tower at just under half capacity, a mismatch that doesn't show up as layoffs yet, but does show up as a building operating well below the revenue efficiency its staffing plan assumed, a gap Boston Properties has to absorb. Somewhere on its books, every single month the vacancy persists. A building engineer who's worked in commercial real estate for over 20 years described the situation to a colleague as the strangest position he's been in professionally. A brand new, architecturally impressive tower, fully staffed and fully operational, quietly bleeding money every month, specifically because of where a tax boundary line happened to be drawn a few blocks away from where his building sits. Multiply this single tower's leasing struggles by however many other buildings within the newly taxed corridor are similarly early in their lease-up cycle, competing against comparable space just outside the boundary that doesn't carry the same premium. The $290 million revenue projection assumed the corridor's existing occupied square footage would simply continue generating revenue at the same rate under the new assessment. Nobody modeled what happens to buildings still actively competing for tenants when the tax boundary itself becomes a factor prospective tenants can simply route around by choosing a building 4 blocks in the other direction. None of this means the underlying goal was wrong. Asking the city's highest value commercial real estate to contribute more toward the city's revenue needs, rather than spreading a tax increase evenly across struggling and thriving corridors alike, is a defensible, even thoughtful approach to progressive taxation. That part of the policy's premise holds up under real scrutiny. What doesn't hold up, at least not yet, is the assumption that a geographically bounded tax corridor wouldn't create exactly the kind of routing behavior that's now costing Boston Properties leases, an assumption that might have held for a stable, fully leased corridor of older buildings, but that broke down almost immediately for a brand new tower still actively competing tenant by tenant against buildings sitting just outside an arbitrary boundary line. A tax structure indexed to a building's actual lease-up stage, rather than a fixed geographic line drawn without reference to which specific buildings were mid-construction or mid-lease-up when the policy took effect, might have generated similar revenue from the corridor's established towers without inadvertently disadvantaging the one building still actively fighting for tenants. It's also worth noting that this isn't a story where Boston Properties did anything wrong, or where City Hall acted in bad faith. The company built exactly the kind of well-capitalized, disciplined project the city says it wants more of. The city, for its part, targeted a genuinely defensible revenue source rather than raising taxes indiscriminately. The gap between those two reasonable positions is where 4 months of lost leasing momentum, a struggling ground floor cafe, and a half-empty tower currently sit. So here's the question worth sitting with. When a tax policy correctly targets the city's highest value real estate but draws its boundary in a way that lets prospective tenants simply relocate a few blocks to avoid it entirely, is that progressive taxation, or is that just handing a competitive advantage to whichever building happens to sit on the other side of the line? Let us know where you land in the comments. And we're not done pulling this thread. Next, we're looking at exactly how the city drew that corridor boundary, and whether any buildings just outside it lobbied to be excluded before the policy was finalized.